Good day, everyone. In this discussion, we will be talking about warranties. Before we start, I would like you to pause the video so that you can capture and you can read the first part of the questions for XYZ company.
We have here two parties, the seller and the buyer. The seller will sell the product with warranty contracts to the buyer, and the buyer will provide consideration or sum of money for the transaction. Now, let's say the buyer will going to exercise the warranty or the contract of warranties. The seller will going to assess if the warranty is within the valid period, then the seller is obliged to perform its obligation. It can be a replacement of the parts, or it can be full replacement of a defective product. I've highlighted some key words. First one is the balance of the estimated warranty liability of 620, then it will be reduced to 120 400. Then we have here our percentage of return 7%, but it will be increased to 10% on May 1. Our formula guide in this problem will be the total estimated sales returns subsequently is equal to the sales multiplied by percentage of sales return and multiply by the return or percentage of return beyond the warranty period. According to the problem, the month following sales will have an expected return of 30. Second month is 20%. The third month is not given, but we can derive it since all in all for the whole year or for the whole period, we will be having 100%, 100% minus 10% each period. So that will be 10 for fourth, 10 for fifth, and 10 for sixth, total of 30. Then less 30 for the first month and less 20. That's how we get 20% for the third month. Then looking at the table, so we will go into plot it. So let's move on to the next slide. We have here our sales pattern. We have for the January, February, March, April, May, June. So our x-axis here will be the sales pattern and the y-axis here will be the month of sale. For example, for our January, since our sales pattern is that on the first month after the sales will be 30%, 20%, 20%, 10, 10, and here in this line, this is our boundary for the June transaction. Okay, we have here 10% as percentage beyond June 20x0. Then likewise with February, February the first month is 30%, 20%, 20%, and 10%. Then beyond the June, it's 10% and 10%. So total of 20 following our sales pattern. So that's why it's 100. For May, it's 70. For April, it's 50. For March, it's 30. For Feb, it's 20. And January, it's 10. Now, let's plot the sales. For January, Feb, March, April, May, June. So we have it here. Then multiply it to the percentage of return, 7% until April, then 10% starting May and June. We will get the amount of return, then multiply it to the percentage of return beyond June 30. Where did we get this? It's coming from this total. Then we have here 640,850. This 640,850 can now be the required estimated warranty liability. Take note guys, according to the problem, we have here the freight cost of 5%. Then we have the manufacturing cost of 70% of the sales, and we have the salvage value, which is averages of or an average of 10%. So if we will going to assess it, since all of these are cash flow, the manufacturing cost of 70% and the freight cost 5%, that will be the net loss. But since we have the recoverable cost of 10%, we will going to offset it to the 75%. That's how we get the 65% here. Meaning from 640,850, 65% will be the required estimated warranty liability. So we have here the 421,753. Then The 620,000 is our beginning balance. Then it says here it will be reduced to 120 in June 30. So we can have the estimated net cost of return from the last year 499,600, which accounts for the movement from 620,000 reduced to 120,400. So the adjustment here will be 301,353. Recap of our answers for the required estimated warranty liability, it's 421,753, and the adjustment for the estimated warranty liability is 301,353. That's it for our video. Thank you all for watching.